Over the last decade, Wall Street entered a new industry that affects you, me, and your dog, healthcare. But now they're starting to face some problems. Between 2012 and 2021, private equity firms purchased 600% more medical practices than the previous decade. That's physician offices, dental clinics, veterinary clinics, and everything in between. And Wall Street was loving the idea of buying medical practices because number one, it's considered a recession-proof industry. Number two, the profit margins are huge. And number three, the competition to buy medical practices is not that high. But now those same institutions that have been buying up the medical practices are facing some problems. For one, the higher interest rates have brought down the valuations of the practices that they've purchased. For two, doctors are retiring or leaving and they can't find new doctors fast enough to staff their practices. And three, new regulations are making it more difficult for private equity to stay involved in healthcare. Now, I know a lot of people have strong opinions as to whether Wall Street should be able to invest in and buy medical practices or not, but that's not the purpose of this video. My goal is to talk about Wall Street buying medical practices from a financial perspective and whether this is creating a bubble. So let me break this down by first explaining how private equity companies work and how they make money. Let's assume that I go out and I create a company called Singh's Guacamole. I make the best guacamole in the area, and now we're doing pretty good. I'm doing about $10 million worth of sales a year. Now, not all of this is profit. I have to pay for expenses. I got to pay for the avocados. I got to pay for my employees. I got to pay for my rent, and I got to pay my own salary. So let's assume that I have $5 million worth of expenses, which means my profit is $5 million. By the way, in the business world, in the financial world, this profit is known as EBITDA. So now, this $5 million worth of profit is the money that this business is making in profits. And if I now, as the owner of this business, want to sell my ownership, one of the things that I could do is I could sell my ownership to a private equity company, an institution that's in the business of buying a lot of companies like mine. That way they can ultimately sell it for a higher profit in the future. Now, what this private equity company might say is, okay, you're making $5 million worth of profit. We think that you are worth 8 times earnings, 8 times EBITDA, 8 times profits. It's all kind of interchangeable, which means that they would be willing to pay me $40 million for the ownership in this company. So now they pay me $40 million. I'm the CEO of the company. They gave me this $40 million, but now they are the owner of the company. Now, I might be required to work there for another 12 months or 24 months or 36 months, depending on what the contract is, or maybe I can just leave as soon as I sign the paperwork. That's all negotiated within the sale, but the key here now is they give me, the owner, a $40 million check, and now they own the profits of this company. But the key that I want you to remember here is when they purchased this from me, they gave me an 8 times multiple. Now they're going to work to do two more things. They're going to work to, number one, increase the profits, and then increase this multiple. So they might work to increase the profits by investing money in advertising, in getting more sales, getting more distribution, and also potentially cutting costs, because these private equity companies are very financially savvy. Me, as the business owner, as the founder, I might not be super financially savvy. This company has a lot of tools, a lot of technology, and a lot of MBAs working to cut all inefficient costs. So what they're going to do is they're going to work to, number one, bring the profits to $7 million. That's the first thing that they're going to do. Then they're going to work to buy a few other guacamole companies, and then they're going to bundle them together. That way they can sell it to a bigger institution on Wall Street. Now, instead of selling it at an 8 times multiple, they might try to sell it at a 11 times multiple to somebody else. So now you take 11, multiply it by 7. That's $77 million. That's how much they're going to try to sell this company to somebody else for. They bought it for $40 million. And they're going to sell it for $77 million to somebody else. That's how the private equity business works. And this is what they've been doing for many, many, many decades. They've been buying finance companies, real estate companies, technology companies, software companies. But over the last decade, especially, private equity saw a huge opportunity in healthcare. Why? Because they really didn't have much competition. If you look at tech companies or software companies, private equity companies are fighting against each other to go out and buy these tech companies, so the valuations were very high. But when it came to medical practices, doctor offices and dental offices and veterinary offices and things like that, they were competing against other doctors who don't have the same pockets as a private equity company. To really hammer this point home, I want you to take a guess. Who do you think is the largest owner of veterinary hospitals in the United States? Take a guess. Want a hint? Think of Snickers. Mars, the company that owns Snickers and Twix and Skittles, is the largest owner of veterinary hospitals in the United States. Why? Because they saw a huge opportunity in this private equity world, particularly in healthcare, more particularly in veterinary offices, because they saw that they could come in, buy veterinary hospitals at lower valuations, and then flip them off at a higher valuation to somebody else. So next time you take your dog in for a checkup, you might want to ask for some chocolate. But now let me wipe this off and explain how private equity works in healthcare, because it's slightly different. So let's assume that I'm a doctor. I'm making my parents' fantasies come true here. If I'm a doctor and I went out and I created a medical clinic called Singh's Health, and it's me and a few doctors that work there, and we are making a $1 million a year in profit, and I am the owner of this medical clinic. Now, what would have happened in the past if, let's say I wanted to retire, I wanted to sell the business, normally I would sell this business to another doctor that would generally want to come in and work in this place. Think of it like a doctor selling off their clinic to a younger associate. When a doctor sells their clinic to another doctor, generally the multiples were lower than what private equity was willing to pay. A doctor might pay another doctor somewhere between 2 to 5 times earnings, just depending on the industry, where it's located, and a whole lot of factors. I know it's a large range, but let's just give that range. So another doctor might pay me, I don't know, $3 million to purchase that clinic from me. This is where private equity came in and said, oh, there's some opportunity here, because we will be coming in and we will be willing to pay a higher multiple to attract the owner to sell to us as opposed to another doctor. And then we, as the private equity firm, are more financially savvy because now we have more profit potential, because instead of us just trying to make the profit every single year, we can flip it to another firm on Wall Street. So this is where private equity started coming in and saying, hey, Mr. Singh, or Dr. Singh in this case, instead of you selling it to another doctor for 3 times earnings, how about you sell it to us on Wall Street or whatever private equity firm for 8 times earnings? So now instead of me getting $3 million for the sale, I could sell it to a private equity firm for $8 million. Now, me as the doctor, I get to make more money, which is great. And now this private equity firm, again, who is not a doctor, comes and buys this clinic, and then they're going to work to acquire a portfolio of clinics and then do the same thing. Work to increase profits. How do they do that? They might charge more money. They might try to get in more patients. They might try to reduce costs. They'll try to do a lot of things. Essentially, they want to increase the profitability. Now, that way they can hopefully turn this from $1 million to $1.5 million. And they bought it at an 8 times multiple. And they might try to sell it now for, I don't know, a 10 times multiple. That way now they can sell it for $15 million. They bought it for $8 million. They're going to try to sell it for $15 million. This is what has been happening in the medical healthcare space for a number of years. But now we're starting to see some changes. This is what we've been covering in Market Briefs. By the way, Market Briefs is my free financial newsletter where my team is working to break down what's happening in things like the economy, housing, stocks, crypto, and the global economy into a fun, witty, and easy to read newsletter. If you haven't joined Market Briefs yet, it's completely free. And I got the link to how you can join down in the description below. But this is where now things get interesting. But let me start by going over who are some of the largest players in the private equity healthcare space in America today. Here we go. Number 1 is Carlyle Group. Number 2 is KKR. Number 3 is Blackstone. And number 4 is Bain Capital. The first issue that private equity firms are facing right now is a drop in valuations. Especially after the pandemic, when interest rates were low, these private equity firms were flush with cash because, well, there was money everywhere and interest rates were low. So private equity firms had unlimited capital, unlimited amounts of dollars to go out and buy these practices. And so they started building up these portfolios of practices. But now, with interest rates a whole lot higher, people are not willing to pay as much money for those same assets. I mean, you could think of it kind of like going out to buy a $500,000 home. It's a little bit easier for you to go out and buy the $500,000 home if you can get a mortgage at 3% as opposed to 7%. Well, that's what we're seeing happen in the private equity space with healthcare right now. With interest rates a whole lot higher, valuations have been falling, kind of like you can see here. Now, that's not a big deal if you're selling your practice. Maybe you don't get 8 times earnings, maybe you get 7 times earnings or 6 times earnings. But the problem is, what about all the medical practices that the private equity firms already purchased and are sitting on their books? Because now they've really ramped up their acquisitions during the last few years when interest rates were very low, but now they're sitting on all these practices that they might not be able to sell at the initial multiples that they were hoping to because interest rates are a whole lot higher, which is why you have Wall Street and private equity companies having their eyes glued on what the Federal Reserve Bank is doing with interest rates, because if interest rates fall, well, that can help valuations rise again. Higher interest rates bring down valuations. Lower interest rates can help raise valuations, which is why pretty much every Wall Street institution is hoping that the Federal Reserve Bank will start cutting interest rates so the valuations of the assets that they own start rising. That way they can help liquidate them as well. Now, of course, just because a business is falling in valuation doesn't necessarily mean that it's losing money, because you still have the profitability aspect as well. The valuation is like your equity in your home. It's kind of an invisible number. As long as the practice is making money, well, it's not that big of a deal because you're still generating a profit, which brings us to the second issue, which is doctor shortages. See, the way that acquisitions work in the healthcare space is many times doctors will sell their practice as a retirement method. Now, not everybody, but many doctors do sell their practices as a way to retire. But the problem is that now doctors are selling off their practices so they can retire, but we're also facing a doctor shortage. So now you have a lot of private equity firms that are working or have worked to build up their portfolio of medical practices, but they're facing a tougher time trying to find doctors to staff their hospitals. And this is a little bit different than something like, say, a software company or a finance company that private equity firms are very comfortable and used to acquiring, because if you want to find another real estate analyst, well, it's not that difficult. There's a lot of them out there, and producing more real estate analysts are not that hard, versus producing more doctors takes a lot more time and a lot more regulations and a lot more work. And we have a lot more limitations when it comes to finding more doctors. So we're starting to see more limitations here because, well, it's not just private equity firms, but the medical industry in general is having a tough time finding physicians and finding doctors that can help staff these medical practices. And this brings us to the third issue that private equity firms are now facing when it comes to the healthcare space, which is regulations. Kind of like what I talked about in the beginning of this video, there's a lot of people that don't like the idea of Wall Street or institutions buying up medical practices. And there's been a lot of proposals at the White House to potentially ban private equity firms from buying hospitals. One of the proposals is called the Health Over Wealth Act, which says that in order to go out and acquire a medical practice, you have to be a licensed physician or a licensed doctor. Now, obviously, the private equity firms are not doctors, so that would bar them from doing that. But these things can create hurdles. Now, these have not been passed yet, but you can start to see that there's been a lot more kind of uproar over private equity going out and acquiring medical practices, which could pose other hurdles for private equity firms. For example, to help combat this, Indiana passed a law giving a special tax credit to doctor-owned healthcare practices to incentivize doctors to sell their medical practices to other doctors and own the medical practices by doctors instead of selling them to private equity firms. So you can start to see that as private equity has come in and purchased more and more of these medical practices, that now the government is starting to get involved as well. So what does all this mean? Well, what's going on with private equity is kind of the same in every industry. We've seen interest rates go up, causing the valuations of certain assets to go down, which is why all of Wall Street is wondering what the Federal Reserve Bank is going to do and if and when they're going to start cutting interest rates, because, well, a lot of Wall Street is sitting on assets which have dropped in value that they can't sell because of the higher interest rates. And so this is why you have a lot of institutions hoping, begging, praying that the Federal Reserve Bank is going to start cutting interest rates sooner rather than later. And the Federal Reserve Bank is really monitoring what's going on with inflation, the job market, and the economy to decide what they're going to do with interest rates. However, if interest rates continue to stay high, that will make it tougher for institutions that are holding onto these assets to sell them and make a profit, especially considering that Wall Street does not get 30-year fixed-rate mortgages. They get shorter-term mortgages and loans. And starting in 2024, these loans are going to start to readjust. They're going to readjust even more in 2025 and then again in 2026, which means that if they're sitting on huge piles of debt and huge piles of assets, that their debt servicing costs can also go up as well. So this is something that you might want to pay attention to because it's a unique space that I haven't really spent a lot of time talking about, but it's something you want to pay attention to because there's a lot of firms that are involved and it affects people in many different ways because, well, everybody has to go to the doctor at some point. So something for you to keep your eye on. Is this something that you found interesting? Is this something that you've seen happen in your area? Let me know down in the comments, and if you got some value out of this video, hit that thumbs up button, hit the subscribe button, and share this video with somebody who you think will get some value as well. You can use OPM, other people's money. Use somebody else's dollars to then invest. That way now you can pay them back a little bit of interest, and then you get to keep the profits. But when it doesn't work, that means now not only did you lose your money that you put into your investment, but now you still owe these people back their money plus interest.